sure that my GPA stays constant. Well, as long as like a 3.8, 3.9, then I'm like, okay, this could be my sacrifice class.
Hello everyone.
It's a hard like class I took it.
Okay, so today as grand planned, we're going to power through a lot of chapter 2. So hold on, we're going to go pretty quick. I'd like to try to get through about half of this. This is the second topic, second chapter of material that is agnostic relative to the type of business entity. So we don't care if we're talking about a corporation, partnership, S corp that owns this particular type of property. The rules apply to this. Okay, so we have one more set of material in chapter 3, and then we'll go into detail on corporations. So my goal today is to split this in half. So we get through the basic rules and be static on this thing, but we're going to talk about the tax basis for cost recovery. That's the first item that we need to understand is what base are we trying to recover from a cost perspective. And then we're going to talk about depreciation, which is your tangible assets. There are basic rules and there are special rules. This is an area where the government always messes around with depreciation. So you just have to be comfortable. Whenever they open up a piece of tax legislation, they will no doubt start messing with depreciation. They feel like depreciation is one of those areas that they can tweak the economy and encourage businesses to do certain things. And so it's a ripe area for change. So the special rules are going to be very important. The One Big Beautiful Bill Act of July 4th, 2025, big changes to depreciation. Taxpayer favorable, largely. So corporations, again, were lobbying for these changes and they got the changes they requested. And then there's going to be some limitations that we're going to talk about on certain types of property. And then we're going to talk about amortization and dissipation. Okay? So the tax, we're going to be talking about acquiring new or used property. So largely we are again agnostic whether it's used property. It doesn't have to be new. So if we buy a piece of equipment to use in our manufacturing facility and it's already been used, that doesn't matter. We've acquired that property. So it doesn't matter if it's new or used. The depreciation methods businesses use to recover the costs of their assets through taxable income and special cost recovery. So when we talk about cost recovery, that can either be during my ownership, which is depreciation or amortization, or it could be when I sell the asset. Because when I sell the asset, chapter 3, we're going to talk about property disposition. That is, I have amount realized because I sold it, I reduce it to my unrecovered tax basis that I still have. So that's kind of the final day of reckoning that I recover any other cost basis that I have that hasn't yet been recovered. So when we say cost recovery, it can mean both through depreciation and amortization and fund sale. So these items can be significant numbers for businesses, especially in CapEx dependent businesses. Those of you that might be following things in the stock market, this week the mega cap tech companies are reporting. One of the key metrics that they're going to be reporting on is their CapEx, right? They are spending mind-boggling numbers on CapEx. So those capital expenditures, they can recover those over time for accounting purposes and tax purposes. Remember I mentioned accounting purposes is based on management's estimates of useful life. Tax purposes, much more regimented, much more prescriptive as to exactly what we're doing. So that's some material we're going to go through here. It's important to understand both the basic depreciation rules, which we're going to talk about today, beginning with the amount that is subject to cost recovery, and the special accelerated depreciation regimes that are enacted from time to time, such as the big pieces of legislation that we constantly encounter, Tax Cuts and Jobs Act of Trump 1.0, 2017, and then Trump 2.0, the One Big Beautiful Bill Act of 2025. lots of special tax depreciation. So we are allowed to use various methods to recover the cost of assets over time through taxable income. That's where I like to think of it. You're recovering it through taxable income, right? So you make an outlay, put an asset on our balance sheet. I recover that cost through depreciation. That's an expense. Well, we're going to be computing. That goes on my tax return. You look down page 1, somewhere like 17, 18, there's going to be depreciation expense. Those are big numbers. But that's how I'm recovering it. I'm recovering it through taxable income. Or I recover it upon sale, which is going to net down my proceeds to that amount. I'm going to be particular here about terms. If you go into the tax space, you want to look smart. Call it what it is. Depreciation is the method of deducting costs of tangible, personal, and real property other than land over time. Okay? So, personal property, it's not personal to you. It's not like this is my personal pen. That's not what we're talking about. It's personal property in this instance is non-real estate property. So, in a business setting, think of equipment and machines. That's going to be your things inside the factory, things inside the warehouse, things inside the office from a building or from desks and computers and IT equipment. All of that is personal property. You contrast that to real estate. Real estate is land and everything permanently fixed. One exception we have is just like the rule in financial accounting, you do not depreciate land itself. Right? I think that's kind of indicative of the uniqueness of land, the finite resource of land. We don't. Land typically increases in value, especially over long enough periods of time. So we have real estate. We're going to talk about real estate probably on Monday, but that's everything but land. So think of factories, warehouses, buildings, headquarters, those types of things we can depreciate, but just not the soil. Amortization is the same method of deducting the cost, but of intangible assets, okay, things we can't touch. Okay, so think of copyrights, patents, formulas, goodwill. Those are things that are valuable in a business. Sometimes a large piece of value of a business from a market cap standpoint, but you can't go out and touch them. They're not personal property. Okay? So when we are talking about appreciating a piece of equipment, I want you to start thinking we're not amortizing. We amortize an intangible, we depreciate a piece of equipment. Okay? Now, depreciation is a special niche area. This is natural resources. So oil, natural gas, coal, those types of things that are taken from the ground. Large companies that do that, some large companies that do that are based in St. Louis. They are dealing with depletion. Depletion is how they recover their investments in the land as they take that part of the land out and do things with it, right? So if you aspire to be in the oil and gas industry in Texas, you'll become an expert in depletion. They are not depreciating, they are not amortizing, they are depleting the natural resources. So I just bring that up because for the vast majority of tax people, they have no idea what depletion is. And that's because it's just a niche area of natural resources.
Is there like an account for depletion itself, or where does that cost go, I guess?
Same thing. It goes on the income statement, and it would be on page 1 of the tax return. But it's going to be the vast majority of companies will never touch depletion, right? They're not in the natural resources. But those that are in the football field. When you walk into those meetings, those people are like talking a foreign language. I enjoy doing it, and I'm like, I have no idea what you guys are talking about, but it sounds good. Okay. So most businesses make a significant investment in property, plant, and equipment that is expected to provide benefits over a number of years. I just did a snapshot here of Ford Motor Company, the car company, and I want you to look at some of these numbers. So total land, plant, and equipment, that is for 2024, $66.971 billion. These are in millions. That's a massive number. Look down here for accumulated depreciation. So this is the amount of depreciation they've taken on those assets for the current year and the prior years. That is $33 million. Massive numbers, right? And this is the the amortization numbers themselves are massive on these things as well. So understanding how these numbers flow through taxable income is a big deal for these large companies. There are people that just do depreciation. And what makes this hard is it's a moving target, right? Because there's things coming in all the time and there's things going out. Meaning that Ford is always making investments in their business, so there's new equipment coming in and there's new equipment that's being discarded or sold. So it's a living database, if you will. And so the depreciation people are tracking all of this and making sure the computations are correct. The other interesting aspect in this area is financial accounting and tax are required to capitalize the cost of assets that have a useful life more than 1 year and expense them throughout time or upon disposition. But they do them differently. So this is a ripe area for book tax differences. When we get to chapter 6 material on tax accounting, this is one of those areas. We have to figure out what the books did, the financial statements did for depreciation. We have to layer in what tax did for depreciation. We have to account for the difference. That's tax accounting. And we'll go through examples of how to do that. But those things will equal over time, because if I bought a piece of equipment for $100 and accounting does one way of depreciating it over time and tax does another, I end up at zero, right? Because I recover it, but I'm going to do it different in each year. Hence, that's the book tax differences. Headed to the same ending point, but I get there in different fashions. Okay. So the first part we want to talk about is tax basis. This represents the amount of investment in an asset that is eligible for cost recovery. And that can be either via depreciation or amortization on sale. Okay? Over time. And so the term tax basis refers to the asset's cost net of accumulated depreciation for tax purposes at any given time. Okay? So, it's not necessarily cost basis, it's tax basis. From a tax perspective, what is my basis in that asset? And as it is decreased by depreciation or amortization deductions, we have a term that comes about called adjusted tax basis. So that's my tax basis after I've taken depreciation deductions. So think about when I sell an asset, and we talk about this in chapter 3. When I sell an asset, I sell it for whatever I sell it for, I recover my tax basis. That tax basis is whatever I haven't recovered already through depreciation. I only get to recover it once. If I take some of it throughout the years that I own it as depreciation expense, it reduces my tax basis to what is called adjusted tax basis, and that's what's left over if I sell it. I can still recover that. Okay? Yes, right.
Tax basis today rely on the company's values, or they appraise the assets?
Okay, great question. So this is not a fair market value concept. Okay, so I'll talk a little bit about in a moment where an instance where fair market value does come into account. But this is purchase price usually. I'll talk in a moment as where there's special cases where it's other than cost basis. But usually your starting point is the same for financial statement purposes as it is for tax. I.e., if you go out and buy, if Ford buys a specialized piece of machinery for $1 million, that's financial statement basis and tax basis, because that's the amount you paid for. That will be the same throughout the life of the asset. It comes down every year as you depreciate it into adjusted basis, but you don't go back in year 3 and revalue the asset. It's just the outlay that you made on the date of acquisition. Some assets are not subject to depreciation. The big ones are land and stock investments, right? We do not depreciate land for financial statement purposes or tax purposes. We do not depreciate stock investments, right? That's a capital asset that you just, your basis is what you paid for it, but you don't, the only recovery of that is on sale, not during development. So we just simply refer to that as your tax basis. I'm trying to convey in this slide, when somebody says adjusted tax basis, that's the amount net of accumulated. Determining the initial basis for an asset is very similar, as we just talked about, for both accounting and tax purposes. Typically, it's your cost plus any expenses to purchase, so if you pay sales tax, and to prepare it for business use, for shipping and installation. So my example of Ford buying $1 million piece of equipment, it's not just $1 million, right? You gotta get it to the location, it's gotta be put on the line, and it's gotta be hooked up and be part of the system, right? That's a cost to get that thing ready to be productive. You add those to the costs of the equipment, and that becomes your tax basis. Okay? You gotta get prepared to operate. So when a business acquires multiple assets in a single purchase, for example, if I buy a new factory and I'm buying the land that the factory sits on as part of that transaction, I need to determine the cost basis for each separate asset. Why? Because the factory is depreciable, the land is not. So I paid one price for two assets in that backpack. So this is an example where I would do an appraisal and I would go out and say, okay, I paid $10 million for these combined assets. Which one, how much pertains to land, how much pertains to the factory? And I gotta separate the assets when I record them on my financial statements. Now, you can see here where a well-advised taxpayer is like, I don't think the land is worth that much. I wanted to put a small amount on the land and a more amount to the factory. Because I'm smart and I know the factory can be depreciated and I can recover that cost through tax income. The amount allocated to land, I never recovered on until sale. That's where the government can take issue with that. They can hire appraisals as well and say, I think you're skewing too much for that because you know what's depreciable and what's not. And I think this is a better breakdown between the land and the non-land.
So if the accounting base and the tax base are the same, how then does the temporary difference?
So the temporary difference is because financial statements will say it is exactly the same number. If I buy multiple assets in a single purchase and the appraisal is used for both financial statement purposes and tax purposes, then from that day forward, the methodologies are different. Because accounting is usually straight line, and it's over management's estimate of useful life. You'll see here in a moment, tax is totally different. We say, no, this is the useful life, and we typically accelerate the depreciation, meaning we take more depreciation earlier in the life of the asset rather than later. So we start day one, you're different from the amount of depreciation expense on the financial statements versus the tax. And that's because there's two different reasons for those preparation of financial statements and tax statements, or tax returns. Right? Financial statements are required to provide useful information to the investing public and the regulators. Taxes to raise revenue for the government, and the government tries to get in, stick their nose in, and try to tweak the economy. If they want to stoke the economy, they accelerate depreciation because that accelerates your decision to buy the equipment. If you are on the fence whether I buy or not buy, there'll be enough in the country to say, oh, well, that tax rule is nice. I'm going to do that. I'll buy it now. That means somebody's going to make it. That stokes the economy. Okay. Businesses may begin recovering the asset for tax purposes once they begin using the asset. So we have technically what is called a placed in service date. We do not get to depreciate the asset until it's placed in service. So my hypothetical of Ford buying the $1 million piece of equipment, if it takes me 3 weeks, a month to get that installed and be productive on the line, I don't get to depreciate that until it's productive on the line. date I own it is not the placed in service date. So depending on how much retrofitting I have to do to get an asset ready to go for my particular use of that asset, it could be the postponed. Okay. Let's do 2-1. 2-1 is Nathan.
So Esteban determined that he needed machinery, office furniture, for a manufacturing facility, and a design studio located in Cody, Wyoming. During 2024, Esteban purchased the following assets and incurred the following costs to prepare the assets for business use. His cost basis in each asset is determined as follows. So we have assets on the left column, so that includes warehouse furniture, machinery. Then we have the date of acquisition to the right, the respective purchase prices, the business preparation costs further right, and then the cost basis, which sums up 1 and 2 all the way on that right.
Yeah, so the big addition here is that preparation costs for 2 of those assets. I gotta do something extra besides just buying the asset. That's not immediately deductible. That goes into the tax base and is depreciated on the rules that we'll talk about. Hit the small print in the bottom, because I probably can't see that, but I think that's important.
So note that the warehouse and the land were purchased together for $345,000. Esteban and the seller determined that the value and cost of the warehouse was $270,000, and the value and cost of the land was $75,000.
So that's just breaking that down to the different components because it's not fully depreciable. I gotta get it there. Okay. When a business incurs additional costs associated with an asset after the asset has been placed in service. So I've already done that example, it's up and running, but I have additional costs that go into that relate to that asset. The question becomes whether those costs are immediately deductible or whether they are capitalized as well. Okay. This answer is imprecise, but it depends upon whether the cost represents routine maintenance, which are immediately deductible, or a betterment or restoration of the property where capitalization is required. Okay. Am I just doing maintenance relative to the equipment? Equipment doesn't, I never have to not spend another dollar on a piece of equipment, right? I have to maintain it. So if I'm doing that, if it's regular routine maintenance, I can just deduct that as incurred as maintenance costs, deductible in the year incurred. Or is it a replacement or a betterment or a restoration? So think of this as a sliding scale between I'm just doing something very routine to it to something I'm doing something more major. At a certain point it becomes capitalizable. Okay? So examples of routine maintenance include the cost of preventative maintenance. I have a list of 10 things that I do every quarter. And that's just trying to fix a problem before it becomes a problem, right? I do upkeep, I do replacement of damaged parts, which are expected to occur more than once. Those would be routine maintenance. Getting the oil changed in something, changing a belt that runs on the piece of equipment. That's just expected, right? Those parts don't last forever. That's just routine maintenance. Contrast that with a betterment or a restoration, which could include the replacement of an entire roof compared to with the repair of 10% of the roof, which is more likely to be considered routine maintenance, right? So the question here from the government's perspective is it immediately deductible or is it deductible over time? I'm going to add it to the tax. So this is just something you gotta work through, but this is going to happen in the real world, right? There will typically, what you'll find is there will be policies that the company will have. We do this if it's X dollars amounts, or we do these things, particular items. Those are always going to be routine. Anything above that, we're going to capitalize. Let's look at 2.2. This is Sam.
So suppose that Esteban's business requires an annual safety certification on all its equipment and machinery. As a result of a required inspection of the machinery, Esteban finds a defect in the engine blade, not a major component of one of his machines, and must replace the engine blade at a cost of $3,000. Can Teton immediately deduct the cost of the new engine blade? yes, he can deduct the $3,000 because the defect was found during a routine maintenance inspection that happens more than once during the machine's life, and the engine blade is a minor component replaced with a comparable part.
Yeah, so I think if you contrast this, and I'm sure that the amount of the cost of the repair is going to be indicative of how important it is. So you have the total cost of the machinery. If that 3,000 pales in comparison to that, it's going to look like it's a minor part. But what if it's a $35,000 part? Maybe that's for betterment. Maybe it's extending the life of the asset. So these are all just factual determinations that one have to work through. Okay. So there are instances where a business or its owner, prior to contributing the asset to the business, may acquire the asset other than by purchase. Okay? The vast majority of assets are going to be acquired by purchase for a business, right? The business is going to go out and acquire the asset. They're going to buy the asset. A1 is going to be pretty simple to determine that. Do you have any shipping and installation and preparation costs that we talked about in that first example? But what if it's a partnership and the partner acquired the asset other than by purchase? And then the partner contributes the asset into the partnership. You have to determine basis in that situation as well. So we're talking about 4 different areas real quickly where there be instances where I look at the basis other than cost. We're talking about via gift, inheritance, when I take an asset that was used personally, and now I want to use it in the business, and then one of my favorites, when it's acquired in a tax-deferred transaction. Okay? So just tumbling through those then. An asset acquired or received via gift involves the transfer of an asset from a living donor to another without the donor receiving anything tangible in exchange. So that's what, that last part, that's what distinguishes it from a sale, right? The transferor didn't get anything. You get a gift, it's just out of the benevolence of the donor. They're giving it to you. So in that instance, if it's appreciated assets, i.e. the fair market value exceeds the donor's basis, via gift are used in a business, the basis for figuring any subsequent cost recovery or amortization in the hands of the recipient is typically equal to the donor's basis. Call that carryover basis. So, Ford Motor Company is not going to get assets via gift. So this is going to be more in a closely held instance or a partnership where somebody gets the asset individually and then puts the asset into the business. So, when someone gets an asset via gift, you take a carryover basis of that asset, meaning that you take the basis the donor had. An appreciated asset, that's probably lower than its value. Why is this important in the business context? Because that lower number is what's going to start depreciation, not the full fair market value. Okay? That's just a function of the transaction of a donor. I contrast that with an inheritance. An inheritance is the same transfer, but the person making the transfer has passed away. In that instance, the rule is different. I take the basis in the asset equals the fair market value of the property on the date the person passed away. Okay. So if that same partner got that asset and it was inherited via somebody who passed away, and they subsequently contributed it to the partnership, then that basis in that asset would be fair market value. Appreciate a bigger number. So I have to look at how the asset came into. Okay. If I have assets that were used personally, and now I want to use them in a business, so again, this is not the Ford Motor Company example. This is more closely held business. But if I had an asset that I used personally, let's say a vehicle, and now I want to contribute that vehicle to the business, and now it's going to be used for delivery purposes for the business. I have an asset that was used personally and now used commercially. When I do that, then I have initial tax basis equal to the lesser of the owner's basis in the asset, i.e. carryover basis, or its fair market value as of the conversion date. And the reason I do this is it's preventing the owner from converting a non-deductible personal loss in an asset into a tax-deductible business loss upon a subsequent sale. I'll come to your question in a second. If I'm using that car personally in my life, and I sell it at a loss, so I just buy it, I paid $50,000 for it, now I sold it to you for $10,000. That loss is non-deductible. If I gave you a lesser of rule, that keeps that not being non-deductible when I convert it to being used in a business by contributing it to the business that's going to use it for delivery purposes. Because if I gave you a carryover basis, then that built-in loss is now in the business. When a business sells it, they would recognize that loss. So in my hypothetical, the business would step that down because the lesser of would be fair market value. So they would start with $10,000. So it's just a way to prevent taking what would be non-deductible and making it deductible by changing where it's being held. Okay, sorry about that.
Just a quick question on the inheritance.
Yeah.
Like, is it fair market value would be determined on the date when they got the inheritance from? Like, what's the date?
Yeah, the date of the person that died, the day of death. Okay. So when a person dies and they own a bunch of assets, they have an estate, and it'll hopefully have documentation of their will and their intentions about who they want to have that asset. But then one of the exercises of managing the estate, the final affairs, is determining the fair market value of all those assets. So if you are inheriting one of those assets, your basis in that asset becomes the fair market value of that asset on the date of death of the person.
Irrespective of whether it was placed in service or not.
Correct. Correct. This is because it's different than purchase. So very rare, right? This doesn't happen to Ford Motor Company. Nobody's dying and willing things to Ford Motor Company. So it's much more in those personal, closely held type businesses. Okay. Last one is tax deferred transactions. This is very common. This happens a lot. This will come up when we do M&A transactions in this course. So when a business itself engages in a tax-deferred asset exchange, we'll talk about exactly that. What is a tax-deferred asset exchange? But think of Ford Motor Company, and it's reorganizing its business. Happens all the time. I think they're publicly have announced that they're reorganizing their EV business because the pickup on EVs is not as what the market they thought it was going to be. So the restructuring that business, it might involve moving assets around within the business. Moving that asset around is going to be done typically on a tax-deferred basis. Ford Motor Company is not wanting to move assets around in its business and start creating a bunch of tax. That would be simple. So they're probably going to try to structure those transactions without paying tax. That's going to cause the basis in the asset to carry over to the other party. So that could be a substituted basis, sorry, not carryover, substituted basis in the asset received equal to the basis as asset in the asset in exchange. So we'll cover this in those transactions, but this is an example where it's not cost basis, it's the asset that you exchange in substituted transactions. We'll go through these in detail, but this is an instance where very common in big companies where assets are moved around and we don't use purchase. If we use purchase price and somebody's paying for it, that would cause it to be taxed. Okay. So, largely we're going to be dealing with cost basis. Businesses buy the asset. When I'm depreciating this, yes, ma'am.
I'm a little confused about the tax deferred one. What's the difference between, like, what is being used as the basis then if it's not?
So when I do a tax deferred asset exchange, I am exchanging one asset for another asset. If I use cash, then it's a sale, and then I have purchase basis. But if I'm exchanging one asset for another asset basis, the asset I receive, I'm going to take a substituted basis. which means it's gonna be the basis in the asset I transferred. I'm gonna substitute that basis for the basis in the new asset. Because the government doesn't want to forgive taxation, they just not tax the return. And the only way I can do that is through substitute basis. We'll go through again, carry over and substitute basis in great detail when we get to that. Okay, so think of depreciation as a constantly changing environment. George.
Yeah, so for that previous example that you're explaining.
Yep.
If the value of the asset maybe went down, you take the substitute.
Yes, yes, yes. The government wants you, in that example, they want Ford to be able to restructure their business by moving assets around, but they don't want to forgive taxation of any of that. They're deferring it, saying we're not going to tax it now, but we're not forgiving it for all time. So they need to carry over gains and losses, built-in gains and losses. The way you do that is through substitute basis. So yeah, it applies to losses. Okay, so this is a constantly moving area. The government is always messing with this. Two seminal pieces of tax legislation recently, TCJA of 2017, Trump 1.0, One Big Beautiful Bill Act of 2025, significantly altered how businesses depreciate assets for tax purposes. However, you still need to understand, we're going to start off with the basic rules. You still need to understand that. The reason being is for, this is the most words I've ever put on a slide. I had trouble getting it all fit on there. That tells you how much, why you need to know this. But one, for older assets. So when I have an asset placed in service, its depreciation is determined based on the law of the time of the placed in service. If the law subsequently changes, I don't change what I've been doing. So think about the people who are doing depreciation. They have these huge databases. They set it up and it's running. The law changes, that only applies to new assets, not the old assets that are still in the recovery period. So older assets placed in service before 2017, and you'll see when we get to the depreciation lives, we have some longer depreciation lives. They're still being depreciated under prior law. So they still are under that prior law, irrespective of subsequent law changes. I have non-qualifying properties. So One Big Beautiful Bill Act, you'll see permanently provided for 100% bonus depreciation. We haven't talked about bonus depreciation yet, but 100% bonus depreciation means you deduct all of the purchase price in the year you place it in service. That's a big benefit. Talk about book tax difference. There is no accounting rules that take a asset purchase with a useful life greater than 1 year and allow you to deduct it in 1 year for accounting purposes. So we immediately have book tax differences there. But think about what the Trump administration is trying to do and the Republicans are trying to do. They're trying to spark the economy. Talking about accelerated depreciation. It doesn't get any more accelerated than giving you 100% of it day one. And the idea is anybody who's thinking about making investments in their business from a property, plant, and equipment perspective, I've dangled a big carrot in front of them. Well, if businesses are buying equipment and property and all that to invest in their business, somebody's got to make it. The person that's making it is hiring people. That's generating economic activity.
If the OPBA provided 100% bonus depreciation for assets that were there before it was implemented, so for instance during the TCJA days,
Yeah.
how would that actually reflect in tax deferred assets when you report it?
Great question. So, fortunately, it does not apply retroactively. So what they did is they extended, they started from beginning of this year. So I believe at the start of this year, you have 100% bonus depreciation. So it didn't affect the prior years. But in instance, if they would have, then you would have to adjust your financial statements and adjust that DTA. And that would get very complicated and very messy. And part of the reason that depreciation rules typically do not apply retroactively is because that asset was already bought. So think of dangling the carrot and I'm trying to influence you to buy something. If you already bought it, I don't have to influence you at all. It's done. You already did that. So I'd be giving you like a free benefit if I decided to let you further depreciate or quickly depreciate something you already own. You already made the decision to buy that. So they're looking at from this day forward, how can I accelerate economic decisions? Okay, so non-qualifying property. One Big Beautiful Bill Act permanently provided 100% bonus depreciation for a lot of assets, but some assets it didn't. So those assets are in the basic rules that we're going to talk about. Qualified production property, this is a brand new category under the One Big Beautiful Bill Act. This introduces a temporary, so when I say temporary, that means the law in itself, the One Big Beautiful Bill Act, sunsets by the mere passage of time for this particular aspect. Permanent means that it's not permanent throughout time because nothing is permanent in the law. It just means there is no sunset within the terms of the bill. Okay? So it will go on until somebody affirmatively comes in and changes the law. Okay? So qualified production activity is brand new. Qualified production property, sorry, is brand new. Companies are getting their arms around what this is. This is a 100% expensing provisions for certain real property used in manufacturing. It's not real, it's not land, but it's production facilities, warehouses, manufacturing. Think about the Trump administration. What do they want? They're trying to incentivize companies to build and manufacture in the United States. If I tell you that you can deduct 100% of that cost this year, that's going to get the attention of the people making the decision whether I should build that next facility here or in another country. Right?
I'm curious if this would apply to like developing a new property, because like you can technically make that like your point of sale for products.
Yep.
Like industrial revenue bonds, you can make like using Chapter 100, you can make that an industrial facility for the time being. Would that apply with this as well?
So there are all kinds of. You see the word qualified, you're going to spend some time understanding what you have to do to make that count for purposes of this rule. And it's pretty powerful, whether you're qualified or non-qualified, because qualified gets 100%. Unqualified does not get 100%. It's spread out over many, many years. So there are all kinds of requirements around this, and I'm just getting my arms around it. But you have to have started the facility, and you have to have finished the facility, and it has to go online at a certain point. Because these things are not like buying a piece of equipment, right? If you're building something, a new warehouse, that takes time, right? A new data center, that's a hot thing going on as well. Those things take time. So they've put parameters around this, again, trying to make sure that this activity is happening sooner rather than later because it's getting jobs, it's getting economic activity. So you would have, if you're building onto an existing facility, I think some of that can count, but the devil's in the details. You have to get in there and make sure that the government will audit the heck out of this as well. This is taking stuff that might be depreciated over decades. These are very long-lived assets. And if you do it in the United States and you meet these parameters, it can be deducted this year. That's pretty powerful. So the government's going to be really focused on making sure what properties people are taking this on and what ones are not. Strategic elections. So taxpayers don't always make money. Some businesses lose money. So if I lose money, then my operating loss carries forward to the next year and can offset income. I may be interested in postponing deduction. So profitable companies are very interested in these accelerated depreciation rules. But if I'm a company losing money, I may not want all those losses now. I plan to be profitable in the future to postpone those deductions so I can elect out of some of these rules. Whereas you normally want to accelerate deductions, that's a good thing. It's a good thing if you're paying tax, but if you're losing money, you might want to postpone those deductions. So there are elections in here where some taxpayers can push these things back out. And then the fifth one, current, we're talking about here, constant change. This is not over by any stretch of the imagination. If you get a Democratic Congress in the midterms, if you get a Democratic president at the next term, they are going to mess with depreciation. No doubt. They may not change the tax rate, but they can stretch depreciation back out, and what that does causes more tax to be paid by businesses. So this will always change, just accept that in this world, moving forward. So we're gonna start with the basic rules. So since 1986, long time for you guys, businesses have calculated their tax depreciation using what is called the maker system. It's modified accelerated cost recovery systems. It's just the regime that was created in 1986. It's referred to as makers, so M-A-K-E-R-S is the way I would pronounce it, even though it's M-A-C-R-S. Makers. To compute makers for an asset, the business needs to know the following info. You will need to know this on the exam. You will need to know this in practice. Okay? You need to know that depreciable basis, what we just spent a few slides on. How did we acquire this? How much? Largely, that's going to be pretty simple. To be acquired. Well, how much did we pay for it? Do we have any cost of getting it ready for use? That's where your first thing you got to have. Then, what was our placed in service date? Any asset was placed in service shortly thereafter, but that's the date you start depreciation. If it takes more time to get it adapted for your use, then it might take more time. It might be a delay between purchasing and placed in service. And then these three things vary based on whether we're talking about personal property or real property. We're going to start with personal property and go to real property. But then I have to determine the depreciation method, the recovery period, and what is called the depreciation convention. The depreciation convention is not a conference that you go to in a nice warm location. It is part of the methodology that we're going to use. Part of this is just understanding how the process works. If you try to jump in line and do something, you're going to miss the right answer. So just be very, very methodical. Okay. So first, depreciable basis is the initial tax basis, however determined. We talked about those four things other than purchase. Gift, inheritance, converting something that was used personally for business, and then was it involved in a tax-deferred transaction. However you got the asset, that's your initial tax basis. Right? Those rules are going to tell you what that is. Less the amount of what you do not know yet of 179 expense and bonus depreciation. Those are two regimes in the special rules we're going to go through. So my tax basis, I'm going to take the hits or take the benefits of those special tax rules, which is section 179, I get a current depreciation amount. Bonus depreciation, I get a year one depreciation amount. What's left is going to be my tax basis. Depends on how the asset was acquired, or purchase, gift, inheritance, or conversion from personal use to business use. The special depreciation rules we're going to cover next Monday on 179 expense and bonus depreciation. So I'm just going through these 5 things here. Placed in service date, we do not start depreciation until it's placed in service, i.e. it's being used. Requires that the property is in a condition or state of readiness and availability for a specifically assigned function. Ford Motor example, it's on the line and it's part of the process of making a car. This requirement can be met when the asset is acquired, but that may not be the case when you have additional installation, modifications to get the asset ready for your use. That may postpone your start of the use. So we're going to start with personal property first. That's all tangible property, so think things you can touch. Computers, machinery, equipment, automobiles for delivery, furniture. That is not real property. Building and land is your real property. Everything else is personal property. So again, it's not my personal pen. Things you can touch. It is believed to be relatively short-lived and is subject to obsolescence over a relatively short time, which is not the case with real property. Right? It's more time-sensitive. Computer, what's the life of a computer? A couple years, 3 years maybe, and then you decide it's too slow for you and you want a new one, or got other problems on it. Whereas a warehouse, longer lives property, right? That's the same thing accounting is going to do. The tax rules take into account that as well. So we have shorter lives for, and then this is where personal property and personal use property are two separate things. Personal use property is things I use in my life, my car, desktop computer I have at home. Yes, I have a desktop computer at home. That's my personal property, my personal use property. Personal property here is everything but real property. Okay, so the third item on that list of the 5 things you need to know is depreciation method. Okay, so for personal property, makers, which is the system that we have for basic rules, provides 3 acceptable methods for depreciating personal property. These are crazy words. 200% double declining balance, 150% declining balance, and straight line. The only difference between all 3 of those is how accelerated they are. They go from the most accelerated to the least accelerated. Right? Straight line is not accelerated at all. Same amount every year. Okay. We're going to talk about the 200% double declining balance method. Because that's what, if the asset was in the basic rules, so it didn't fall within 179 or bonus depreciation, which we'll cover later, it's going to be, the business is typically going to want to depreciate it as fast as possible. That's going to be the 200% double declining balance. This is the default method and provides the most accelerated depreciation deduction. Effectively, the reason the wordy reference to 200% double declining balance is the calculation takes twice the straight line method in the first year and continues to do so in subsequent years until switching to the straight line method in the year that that method provides greater depreciation. That's just how it's done. Luckily, you don't have to do that because the government provides us tables that have already done all this. So I'll show you how to use the tables. The reason it's called that is because that's what it's doing. It's taking twice straight line until such time as straight line is greater than that, and then it falls back to straight line. Okay. The 150% declining balance or the straight line methods may be attractive in cases when either the taxpayer expects higher marginal tax rates in the future, pushing depreciation deductions in those higher tax rate years. So if you thought that the Democrats will take over the White House and Congress in the next presidential election, and you thought that they were in favor of a higher corporate tax rate than 21, which mostly they are, then you might say, do I want to take a deduction in a 21% year, or would I like to take a depreciation deduction in a 28% year, which was the last Biden proposal. He wanted to go to 28. And so that might work into your favor if you might want the most accelerated. Yeah.
If that's the case where you're thinking like you want to kind of not accelerate it as much as possible, why would you even go straight line?
It might be straight line. Yeah. Sorry. It might be just do you want a little bit this year and that, so it might be the middle case of that. But you're right. And now that's you're betting on the future, and that might be something that you could do as a public security corporation. You want to take a bird in hand and get that deduction. Okay. So then the fourth item on the list is recovery period. So I need to determine the recovery period, and for personal property, remember, financial statement, financial accounting purposes, the recovery period of depreciable life is estimated useful life as determined by management. Not the case for tax purposes. We have specific rules that tell us exactly what the recovery period is by type of asset. Okay? And that is in what is abbreviated as Rev Proc. That stands for revenue procedure. These are documents that are issued by the government over time from the IRS telling them how they are going to apply the tax code. Okay, so it's basically a practical document issued by the government as to how we want you to operate the tax code. So it's not necessarily in the statute. It's the government body that is applying the statute. This one is very old, 87. So the first letter there is the year, 1987. 56 is the 56th revenue procedure issued that year. So, when you're doing research, you'll find rev procs from 91, 26. That means from 1991 is the 26th one. Okay. This helps taxpayers categorize each of their assets based on the property's description. So once the business has determined the appropriate recovery period for its assets, it uses this rev proc to identify the recovery period for all assets in a particular category. So the people I was mentioning at Ford Motor Company that are doing depreciation know this rev proc forwards and backwards. They are tracking all this activity during the year, all the comings and goings of PPG, and will then set the recovery period based on this revenue procedure. It is not dependent on whether the property placed in service is new or used. The length of time the prior owner held the property is irrelevant. So it's just when the asset comes in the door of Ford. What is the asset? This revenue procedure will tell you the recovery period. It doesn't matter if it's new or used. It's been used for 50 years. It doesn't matter. Okay, so here's an excerpt of this lengthy document, but here's the part that I want you guys to understand. So this is cars, light, general trucks, and computers and peripheral equipment, recovery period 5 years. So we don't get in for tax purposes and say, oh, well, this piece of computer or this piece of software is going to be used for 3 years. Doesn't matter, it says 5. You might be using 3 for financial statement purposes. The government tells you 5 for tax purposes. Right? So it's not a subjective determination here of what's the useful life. Same doesn't apply if the property can be used for 7 years. Doesn't matter, 5. Right? Very prescriptive.
I just wasn't clear about like if a property has already been used and we still keep it the original recovery period. Doesn't make sense to me.
Yeah, so I think that's just the government doesn't want to get involved in what happened prior to your ownership. If you bought these types of assets and they came in your door, this is the new life of that asset. Irrespective of if it's already been used for half of its functional, useful life.
You cannot even use it anymore.
They shouldn't have bought it, but so there's a practical element to that as well. But that's where the government, I think, just we can't get involved in what happened before that because you may or may not know. Because the seller may not tell you.
So when you take over a company and it has these type of assets, you essentially restart this recovery period?
So the answer is no. So in an M&A transaction, there's 2 ways to do an M&A transaction. You're either acquiring the stock of a company or you're buying the assets of a company. So I shouldn't say no, it depends. If you're buying the stock of a company, whatever they're doing in this area keeps on keeping on. Nothing restarts. If you bought the stock, stock is non-depreciable. The business continues as it always has. Lives, all depreciation just keeps on going. Contrast that if your M&A transaction is, I went in and I bought the assets of a company, then it's the rule we were just talking about. They're new assets to you. What are the assets? What is the useful life? So it's no different if you bought an asset from a vendor that just produces that asset, or you went to a competitor and you bought their assets. Those are new assets to you, so you would start fresh.
Okay, so you have the flexibility to choose any depreciation method? That makes sense?
Depending on the overall business structure of the transaction. So if it's structured as an asset deal or a stock deal, which we'll talk about why you may not have much influence over that, there's lots of factors that come into that. But that will then drive whether you get a fresh start or you carry on what they're already doing. And I don't want to say you have a lot of flexibility. You have flexibility if you can, flexibility in the overall transaction. Once the transaction's been set, you have no flexibility. Either keep on doing what you've been doing or you start fresh. Okay, office furniture, fixtures, and equipment, 7 years. Qualified improvement property, 15 years. So all this document is very extensive. All the possible assets you can have, they will bucket them in types of years. Okay. Then the fifth item was the depreciation convention. Okay, don't get to go to Orlando and talk about this. The convention, the methodology. So for personal property, the depreciation conventions specify the portion of the full year's depreciation the business can deduct in the first year and the final year of depreciation. Because think about the government's perspective here. Let's take a calendar year, right? We talked about tax years on Monday. Calendar year, January 1 to December 31st. Do I give the same level of depreciation to a taxpayer who acquires a piece of equipment on December 30th as I do one who buys it on January 2nd? Okay. They've held it for a different period of time. Should I give more depreciation or not? What the government does in these conventions, they give a half-year convention and what is called a mid-quarter convention. The half-year convention applies to everybody. And I think this is an administrative convenience for the government in saying, I'm not going to get into the person who buys the asset on January 2nd gets 364 days over 365 of depreciation that year, which sounds reasonable. We could all agree to that. Or the person who buys it on December 30th, I give them 1 day over 365 days of depreciation for that year. Again, sounds reasonable. The government just says, if you buy it in the year of purchase, you get half what you would otherwise get in that year. And in the final year, you get half of what you would otherwise get in that year. And I think that's just administratively convenient for them because they're saying, when I look at the portfolio of companies across the country, about half of them did it early, half of them did it late. So I'm just going to arbitrarily say you did that. Again, very prescriptive. That's what the convention is saying. So the mid-quarter convention is this strange guy where you load up all of your asset acquisitions at the end of the year. This is the government going to give you even less depreciation in the first year. Because all you're really doing is you're sitting on the fence in December and you hear the business people say, oh, we're going to make all this investment in this new machinery and equipment that we're doing for a new line, a new model for Ford Motor Company. You could tell them, hey, buy it this year and I get half the depreciation this year. Buy it in December. Instead of buying it in January, which is only a few weeks away, and then I only get half next year, right? So the mid-quarter is looking at, are companies inappropriately shifting a bunch of their acquisition of property, plant, and equipment in the final quarter? We'll go through what the mid-quarter does. Luckily, again, all of this is in tables. I'm just giving you kind of the rationale of what these tables mean, why you're going to go to. Okay. The convention is determined annually for assets placed in service in that year and remains the same for the entire recovery period for those assets, regardless of what convention applies to assets placed in service. So once you set something up, it continues to run out based on the law at that time. We don't care about future law changes, and we don't care about the next class of assets that come in that year. Right? You got like all these multiple years kind of running their course. And what makes this challenging is things are getting sold as well, right? The business people are moving in and out of assets. You're going to pull it out if you sold it and all that type of stuff. So, okay, the half-year convention. This is built into the depreciation tables that we're going to talk about that the IRS provides us. So this is 1/2 of a full year's depreciation is allowed in the first year, regardless of when you acquired that asset, placed it in service. My January 2nd and my December 30th hypothetical, you get the same depreciation in year one, half that year. I think that's the government looking at in totality of the entire population of taxpayers. That's fair to the government. Not fair amongst the taxpayers, but how are they paying? If an asset is disposed before it is fully depreciated, only 1/2 of the otherwise allowable depreciation, as determined, we will do this in the table, is allowed in the year of disposition. But again, it doesn't matter what point in the year in which the disposition happens in the year, you get half that. And again, I think that's administrative convenience. The government's saying in total, some taxpayers are probably doing it early, some are probably doing it late, but half. Some people This is all built into those tables. Okay. Mid-quarter convention. So this is, the computation here that you'll have to do is, does more than 40% of the total personal property for a given year, is it placed in service in the fourth quarter of the year? Fourth quarter meaning calendar year, September 1st through the 31st, right? If I've inappropriately loaded all of my PP&E into that fourth quarter, estimate being 40% is the government's objective determination of that, then I am now in the mid-quarter convention. Now I have separate tables that I go through, and this will effectively lower the amount of first-year depreciation that I get. I'm in mid-quarter. That's where the government's saying, I think taxpayers are well advised now and they understand the half-year rule. I'm going to have too many people waiting until, October, November, December. Have too many people waiting there knowing that they're going to still get a half-year depreciation. So I'm going to set up this separate regime to capture those taxpayers, not give them as much depreciation. They're waiting too much. Okay, so this is an important slide. If you want to know how to do depreciation under the basic rules, you have to follow these 4 steps. If you follow these 4 steps correctly, you will always get the right answer. If you don't, you won't get the right answer. Okay? So, first I have to determine the depreciation convention, what we just talked about. I first test, I look at everything that came online, did more than 40% get added in the fourth quarter? Yes or no? If it's yes, I have a mid-quarter convention and I have to go to those tables. If no, I fall back to the half-quarter convention.
Going back to the mid-quarter convention, so for the other, let's say it's like 45% of the assets are placed in that fourth quarter, so for all 100% of the assets, are you assuming it's fourth quarter?
Yep. Yeah, I have. It just tells me what tables I have to go to, but it's going to account for that because I skewed too much to the fourth quarter. But that's an important point. It's not just those assets. Okay. Then I have to locate the appropriate table. I will give you the tables on the final exam. So, but you have to know which one you're going to because they're going to have a bunch of percentages on them. If you get on the wrong table, then your math is not going to work. And you're going to have an incorrect answer. So, first test for the convention, yes or no, 40%. Second, that's going to lead me to the right tables. If I get on the right table, then my columns in the tables, you'll see shortly, is going to be the recovery period. Then I find the row for the particular year, because it's going to have the years, and I connect the column and the row for the year that I asked you about. That will be my percentage that I multiply times my depreciable base. Okay? So the intersection of those two times that will always give me the right answer. So let's do our first example. 2-4 is Flora. One on here. Anybody want to do 2-4 or you want me to do? I'll do 2. Okay. So Teton is using the 200% declining balance method in half-year convention. So they've already tested the mid-quarter. And the answer was no. I did not inappropriately put more than 40% of my assets placed in service in October, November, December. Okay? So that I fall back to half-year convention. To compute depreciation on its 2024 personal property additions. What is their depreciation deduction for these assets? So you see all the assets here. We have the placed in service. This is where I would do that first step here. Did I have 40% or more in that fourth quarter? The answer is no, because these are first, second, and third quarters, nothing in the fourth quarter. And so now I have to do locate the applicable depreciation table. So now I'm going to look for 200% double declining balance half year. I've included what that is. This does not change. This is in that revenue procedure. It doesn't change. It's mathematical. It doesn't change by year. No inflation adjustments here. So I would go by and I would have cited for each one of these assets, I would give you this information as to what is the recovery period. That would be these guys here. And you see these years, they correspond to office furniture, machinery, and used delivery truck. And so then my original basis, that's the purchase price for these assets. This is the key column you need to get to. How do I get there? So let's just take the first item, office furniture. I am half year. So I have Maker's half year convention is table 1. I give you these on the back of an exam. There will be multiple tables. You find this table, and office furniture is 7 years from that rev proc. And we're in year 1. So the intersection of column 7 years, year 1 is 14.29. That is this number. 14.929 times 220,000 is 2,858. That's my year 1 depreciation. Right? I would do the same thing for machinery. It's 14.29. The delivery truck is 20% because it's 5 years. Okay? That gets me $95,000. So I've determined I didn't inappropriately shift it to the fourth quarter. And I'm in the general half-year convention. I find that table. I gotta know what column I'm in and what year I'm asking about. Okay. So once I set them up, this is the remaining. Nothing changes for them in the future years. So that next year it'll be 24.49 for the 7-year property, all the way down. And guess what? Each one of these columns split to 100%. Get it over time. You'll see the acceleration in these percentages, 14.9 to 24, 17 to 12. It's slanted forward, it's accelerated, but I have this half year, that's why the first year is less than the second year. Because the government's trying to deal with the macro level factors of putting things on in different times, placing them in services. If you follow those steps, you'll always get to the right answer. Okay, does somebody have 2.5? 2.5 is Sam. Oh, that's 2.2. 2.5, sorry. Okay, sorry.
Yes, so the question states that we're assuming that Teton will be tangible personal property acquired and placed into service in 2024, so the assets are fully depreciated. Using the IRS provided tables, how would Teton determine its depreciation expense for 2024 through 2030? And then use the following table to
So it's running them all out through the years, and you see it goes to year 8. Why? Because the maximum recovery period I had here was 7. Remember, I get half year in the first year and then half in the final year. Why it's spread out 7-year property over 8 years of recovery. And each one of these is the full amount of the purchase price of the asset. Right? And so what happens is then if one of these assets gets sold in the middle, that's where I have an adjusted tax basis, right? Because I still have cost basis that I haven't yet recovered because I had future years. That's where I would recover the rest of it on sale. Less my amount realized, less my adjusted tax basis equals my gain or loss. Okay. 2.6. Who has 2.6? My list. Eva? Eva? Fine.
Sells all of its office furniture in 2025, the year after it buys it. What is Teton's depreciation for the office furniture in the year 2025? So you would take the amount that the office furniture cost in this first spot, which is 20,000, then multiply it by the 7-year property in 2022.
And that would just be because you've already done all that work in the prior example. You're just on a second row, and that percentage is 24.49.
And then you would multiply that by the depreciation limit.
so that's the final year's depreciation, no matter when in that year they sell the property. Okay. And then any other unrecovered basis, they would recover through the disposition.
So would you use the March table no matter their depreciation method?
You would use this table only if I told you only if you tested and you did not meet the mid-quarter. You'd be in table 1. Table 1 is a pretty important table, because that's going to be the majority of the depreciation that you're going to be doing. So you would use that. But if you hit the mid-quarter, because you had more than 40%, then you're not in this table. It's up to you. It's going to run that amount you can get. Okay. Second part.
Assume that someone sold all of his office furniture in year 1, year bought it and placed it in service. How much depreciation they deduct the tax furniture in year 1? That would be $0.
So sort of a weird rule. I'd say you probably you're not gonna account for this very much. Businesses don't buy an asset and then turn around and sell it in the same way they purchased it, right? Why'd you buy it in the first place? You bought it and sell it. I assume maybe it happens. But the technical rule is you get no depreciation if you haven't held it in the first. Okay, 2.7. 2.7 is This is where we'll end up, but I want to contrast what Jeremiah was asking about. If I go to a different table, different set of tables. Okay.
So for this example, assume the machinery was placed in service on November 1st, 2024, which would be the fourth quarter rather than July 22nd. What is 10's 2024 depreciation for this personal property addition? And the answer would be $30,527. And it would be computed using the tables, and it's different because 40% of assets were placed in service during the last quarter. It's the machinery for which the purchase date was changed, and because of that, you would use the mid-quarter convention. So office percentage of 25% is located. It's all in the tables. On the next slide.
So let's walk through this. So the we're in the mid-quarter convention. So now I have 4 tables. Why? Because there's 4 quarters. Right? And so the mid-quarter convention, so this first one is placed in service during the first quarter, second quarter, third quarter, and fourth quarter. That's the only reason I have 2A, 2B, 2C, 2D. Okay? And so then, since this acquisition, as Matt is saying, skews me into the mid-quarter convention, put so much in the fourth quarter, then I have to go for each one of these, which quarter was it placed in service? And that sends me to the table that I need to get to. So if I did office furniture first quarter, then that's here. Because office furniture is 7 year. And it was placed in the first quarter. 25%. So this is the important calculations. And so you'll see the machinery was placed in the fourth quarter. And I go to that, and that is 3.57. Very little in the first quarter, and that zooms all the way up to 27% the second year. So you see how what I slammed in the fourth quarter got skinny down very, very little because I bought it November 1st. The government doesn't want to give me even a half year under the half year convention. It wants to skinny that down. So that's why it's causing me to get that at the end of the day. And I don't think there's much else. But that's why you gotta do that first test. If I jumped here and I started doing table 1, I got totally wrong percentages, right? And if I found that out in year 3, I've been doing 3 years wrong. Not right? It's all botched up. So you test first for placed in service, 2 skewed to the fourth quarter. If it is, then I gotta go back, take all of the assets, use table 2, and use one of the 4 based on when that particular asset was placed in service in that quarter. And that will tell me the depreciation. Does that make sense? It's all about getting to the right table.